wasting money on cures. Forgot how to fix myself. They say that time is free. Then why is it so precious? Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. Time is running out. Time is running out. Lately I've lost my track. I've sailed the deeper seas, hoping to find something to bring back better times. Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. But time is running out. 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 Time is running. Time is running out. But time is running out. What if my best days are over? They can't be over. They can't be over now. Time is running out. What if my best days are over? They can't be over now. Time is running out. Time is running out. Time is running out.
Okay, hi everybody, welcome to the latest in our series of live stream revision sessions. Today we're going to focus on financial markets, and we've got lots of great questions for you, lots of multiple choice short answer questions. As always, if you're watching on the live stream, welcome to new and old participants. You need to be subscribed to the channel to post in the live chat, so please do that if you want to contribute your answers. And critically, if you're watching on replay, just press that pause button at any time you like if you want to take a moment to think about a question and maybe revise your own answer before we go through it together. Just before we kick off on financial markets, quick reminder that in a couple of weeks' time, from Tuesday, the 23rd of April, through to the end of that week, we are live in London again for the final week, the fourth week of our Grade Booster revision tour. We've been to Newcastle, Manchester, Leeds, Bristol, Birmingham. We had a great week in London the week before last. Now, from Tuesday the 23rd, we have 4 dates for in London, 2 at Westfield Stratford and 2 at Westfield White City. And we are pretty full, but there are still places available. I'll be there all 4 days presenting the Grade Booster Economics. Be great to see you there. And we also have other subjects: psychology, sociology, business, law, politics, much more besides. And geography. So do check it out. If you go to the website, we posted a link, I think, in the live chat, but we'll also post some links in the comment sections. There's our revision sessions, the final week of Grade Booster, which kicks off on Tuesday, the 23rd of April. And I'm really looking forward to that. Okay, financial markets it is today. Here's our first multiple choice question. I've got 5 multiple choice questions for you. Please post your answers in the chat window. What is the fundamental difference between debt and equity? So here's our first question. What is the fundamental difference between debt and equity? What do we think? I'll pick out some students who are contributing and getting the right answers, and a lot of you are straight in Harry and Monty, Summer and Christian, Faye and Hannah have all given the right answer, which is coming up now, and the answer is C. Debt, of course, is liability, borrowed money. Equity represents ownership in a company. Great start. Here's question number 2. Now, this is a hard one. What is found on the liabilities side of a commercial bank's balance sheet? If you think about a bank like Barclays or HSBC or Santander, what would you find on the liabilities side of a bank's balance sheet? Don't forget, a bank has liabilities and assets. And the answers are coming through. Emily, Amelia, James, we've got Chris and Harry, Esther have all got the right answer. Coming up on the screen, deposits and borrowings. Yeah, so when a savings deposit is a liability to the bank, I can go to NatWest this afternoon and take out £2,000 worth of savings. The only problem is I don't have a bank account with NatWest. But if I did, then that would be a good move. By the way, I've just had an email from my bank manager, a really nice email saying that my debt is outstanding. What a lovely start to the day. Here's question 3. Now this is a great question. This is particularly for AQA students. What might lead to conflicts between the objectives of a commercial bank? So as part of the spec, you need to know the kind of different objectives of a bank, but crucially, the balancing factors. So what do we think? Isaac says, well done, Geoff. Is that about the outstanding debt? That's really nice. Okay, so Toby and a lot of difference here. A lot of differences. We're getting you can use this for Excel, by the way. You need to know this for Excel. Okay, a lot of people here saying B. It's not B, but Chris and Amelia have the right answer. So well done to them. This is a tricky question. So a lot of people saying B. In fact, we're saying a majority saying B. Danlek saying D. Freddie has the right answer. And here it comes. It is A. If you go for liquidity, so if you hold, let's say, for example, you put £5,000 in the bank account. If the bank holds £5,000 in cash, it's very highly liquid assets and liabilities, but it doesn't make any money. In fact, in real terms, of course, you lose money. Oftentimes, if you make out a loan, if you grant a loan, you are decreasing liquidity in the bank, but in theory, increasing profitability, providing those people pay the loan back with interest. So banks that are required to increase their liquidity may see a fall in profitability. Jack Seaborn saying that he invested this week in Reddit. Quite an interesting idea. I'm pleased, by the way, Jack, you didn't invest in Truth Social, but that's another issue. Question 4. I like this one. Which term best describes the risk of a collapse or failure of an entire banking system leading to widespread economic turmoil? What do we think here? Which term is the best of those options there to describe the risk, if you like, the systemic risk of how a banking system can have widespread economic effects? Loads of people kicking in. Great answers from Jacob, from Ladsky 111, and the answer is financial contagion. Now, sovereign default, when government debt is defaulted on, that can obviously have significant macro consequences, but we're really talking about financial contagion, aka the subprime crisis in the States, which of course a relatively small event in the States having huge global consequences. Sheila says, is that what happened last year at SVB, Silicon Valley Bank? Yeah, well, interestingly, what Silicon Valley Bank did, they invested heavily in US treasuries, US bonds. So they attracted a lot of deposits, in particular from internet companies, from web businesses. Pardon me. They then invested the money in bonds. They didn't really lend out to anybody. They just invested in bonds, which is great when bond prices are going up. But then the US Central Bank, Federal Reserve, started raising interest rates, obviously in 2021, 22. Bond prices fell as a result. And Silicon Valley Bank went to the wall. Of course, it was bailed out. Wasn't it bought by, is it JP Morgan or Morgan Stanley for $1? Jacob says, get yourself a 222 beanie, guys. Well, yeah, they are prized. Indeed, very, very prized. James says, is financial contagion the same as systemic risk? And the answer is yes. Now, question 5, our last multiple choice question today. How does a bank's capital ratio affect its ability to absorb losses? How do we What do we think on this one? How does a bank's capital ratio affect its ability to absorb losses? For example, bank losses during a recession. And yeah, you're doing well here. So well done to Parth, to Freddie, to Dia, to Esther. Monty's in there, and Sheila with the right answer, and Josh as well. Here it comes. If you have higher capital ratios, then that indicates a higher ability to absorb a loss. We'll come back to that in a few minutes. Well done on that. Okay, let's crack on with financial markets. Here's a 1 minute outline question. Let's see what the best answers we can have, and we'll post some of the answers in the live stream. Here's a minute. How can banks create credit? Over to you. Have a go. We're just looking for a nice, snappy answer. How do commercial banks create credit? What's the mechanism? If you can give me a short sentence, even better. It's not easy in a minute, but some people are tight like the wind. There's some good answers coming through, and we'll pick out some of them. Thank you, Harbeard. Really good answer. Harbeard's got it. Fractional reserve banking would be a big part of the answer, I think. Well done. We'll try and pick out 2 or 3 more. Thank you, James and Alice. Well done. So we're really focusing here on the process of credit creation. Well done. And Jim's in the Choo Choo production studio today picking out the answers, and we'll try and pick out 4 or 5 for each of the little exercises. Fantastic. So Dan B says consumers deposit in the bank, and the bank then lends out a proportion of those deposits. And a lot of people talk about fractional reserve banking, which is super important. Now, I want to just quash a myth. So Sheila, loaning to businesses. Yeah, you create credit when you give them a loan. I just want to quash a myth here that banks have to attract deposits. Here's my answer coming up on the screen for you. So how do banks create credit? Banks create credit through fractional reserve banking. When a bank receives a deposit, it holds a small fraction, perhaps less than 1%, as cash reserves. The rest can be lent out as loans, assuming there are people who are out there wanting to borrow money. And these loans create new deposits in the banking system, effectively expanding the money supply. By the way, keep an eye on the chat window, everybody. There's some great answers coming through on the lads' response, and they are really tremendous. We get great value, by the way, as a teacher and a student, just watching the answers of students. They're bang on it. I just want to quash the myth, by the way, that banks have to attract deposits. They don't. You can be a bank without attracting any deposits at all, providing you find the money from somewhere, providing you can fund your lending. And banks create credit by literally just lending out money. So if I was a bank, if Choo Choo was a bank, I would be sat here at my lappy giving out loans. On a spreadsheet, I'd be a loan, an asset and a liability. So that's what banks do. In modern banking, a loan is when the bank says to you, yeah, Riley, here's £50,000 to improve your house. Okay, that's created £50,000. There has to be something behind it. And you've got to assume that I'm going to pay it back, which is not a realistic assumption. Next question coming up. Superb. Oh yeah, let's look at profitability of banks. Now this is the net profit last year of the largest banks in the UK. Keep in mind HSBC's profits there, which is 31 billion last year. Keep in mind, of course, HSBC is a global bank. It's Britain's biggest bank, one of the world's biggest banks, of course. £31 billion globally. But Lloyds, Barclays, NatWest, Standard Chartered, they're all making profits in excess of 4 billion. Here is my question for you. Can you give me 2 factors that affect the profitability of banks in the UK? Let's have a go at this one. Yes, commercial banking, as GT2 fan says, is essentially an oligopoly. So you would expect them to make supernormal profits. But what are some of the factors that affect the profitability of banks? This would be a good, well done, Teddy. Head of school. Congratulations. So Teddy's there talking about interest rates and the economic cycle. 2 very good points. I'll just give you a little bit more detail on that, Teddy, in a second. Faye talking about confidence. So what can affect the profitability of banks? James talks about assets liabilities ratio, the liquidity of assets. Yes, going back to a point we made before. Oh, here we go. Dia has provided for us just a cornucopia, a smorgasbord of factors. Confidence, economic growth, yes. You'd expect bank profits to be cyclical, wouldn't you? Probably. Competition laws, CMA could intervene. Windfall taxes, so that would affect the post-tax profitability, and interest rates. Wow, absolutely fantastic. Yeah, Jacob talking about exchange rates affecting bank lending, for example. If you're lending overseas and you convert back to sterling, that affects the profits. Wow, this is interesting. Lots of people seem to be well up on their financial economics. Can I take you through my two answers? So net interest margin. So I sometimes call this the interest spread. So basically the interest margin is the gap, the difference between the interest rate you charge to your borrowers and the interest rate you pay to your savers, your depositors. So if you're charging 6% on a loan and paying savers 3%, the spread is 3%. Now, typically when the economy is doing well, when the economic conditions are positive, banks often say, well, this is the moment maybe to widen the spread, maybe pay savers a bit more, but pay borrowers a lot more. And in fact, rising interest rates are nearly always good news for banks, nearly always. The other key thing is credit quality and loan defaults. So what really hits banks are non-performing assets. In other words, you lend out to people and they default in whole or in part, and therefore you have to take a hit on non-performing loans. And banks have also made losses on other assets. So Silicon Valley Bank, I think Sheila mentioned that, SVB failed last year, of course, because they made big losses on government bonds. Jacob says, are both economics workshops the same? Well, one's for AQA and one's for EdXL. So most of our sessions are specific to the exam board of both. Certainly sessions 3 and 4 are very exam focused. Jay says, are these part of EdXL? The answer is yes. This is all good financial economics for EdXL because I teach EdXL. Just want to show you this chart, by the way, just to keep in mind, a little bit of application for you. If you get a question on interest rates in the UK, base rates, what, 5.25% as of now, shown in the little histogram there. But then look at credit card interest rates. Now, credit card interest rates are now on average of close on 25%. So, there's a little bit of application for you that the interest you pay on your credit card is probably 5 times higher than the base rate. So if you have credit card debt, there's something like £240 billion of credit card debt in the UK, you are paying a staggeringly high rate of interest. Aaron says, I don't remember EdXL going into this depth. Well, the point about this session, Aaron, is to add to your stock of knowledge in this area. Next question, let's think about digital banks. Now, this is potentially EdXL, by the way, because they may well ask a question on barriers to entry, monopoly power in a banking industry. Now, I've chosen Monzo as my example. Lots of students have a Monzo card, I think. Take a quick look at the numbers here. So Monzo was established nearly 10 years ago, 2015, UK-based bank, providing current accounts to people and in particular to small businesses. They've now increased the number of customers from 1.6 to 7.4 million. The bank with just under 2,500 employees, they've got nearly £6 billion in deposits, and they lent out nearly 800 million just last year. So what a really good example of a disruptor or a challenger bank. Here's my question for the group. And this is microeconomics, but it's obviously financial as well. Can you give me 2 examples of barriers to entry into the UK banking sector? Let's see what the great team economics can come up with on this question. Have a go. What I've chosen here, everybody, are topics that I think are useful financial economics for all boards. We'll look at bonds, we'll look at banks, we'll look at financial market failure in a second for EdXL. But this question is interesting. This is about barriers to entry in an industry, and I've chosen the banking sector. So what are the barriers for businesses like Revolut, Monzo, Starling, Metro, and others? Okay. Well, great answer from Freddie there. So just think micro here, everybody. What are some of the potential entry barriers? Dan B has a lovely behavioural economics point. Well done. And G9 That's a great answer coming through there. Well done, Ollie. Great answer. Habitual behaviour, high startup costs, regulation. Yeah, there we go. So, by the way, I thought it was a really interesting question because let's apply financial economics to market structures. The banking industry has a high risk of sunk costs, so the barriers to entry are high. Consumers only deposit in banks they trust. Good point. So there's high brand loyalty. So who knows? They may well, because of course the exam changes over time. The spec doesn't change, but the focus often changes. They may well give a little question on banking, the rise of challenger banks. Ollie talks about regulation. Revolut is applied to be able to lend to customers past 3 years, still yet to be approved. Really great application, Ollie. And indeed, I think Revolut are now thinking of listing in the States rather than the UK because of difficulties in getting lending licenses from the bank. Yeah, Will Blanston talked about the sheer difficulty of getting a foot in the market due to the top 4 banks holding so much market share. Lovely hint there at the barriers to entry in oligopolistic markets. Here are my 2 points if you want to add value. Regulatory compliance and capital requirements. So if you're a new entrant, you must have enough capital. Where do you get it from? Well, you can get it from deposits, from savers. That's not always easy, but you might be able to get some money from investors. But crucially, you need a banking license. You need a banking license from the Bank of England. If Tutor2 wanted to become a bank, it has to have a license to both take deposits and lend out. Obviously, millions would be flocking to the Tutor2 bank. It would have an amazing global reach straight away, but never mind. Digital banks, of course, operate only online. So that eliminates the need for physical branches. That lowers the entry barriers. The other one, of course, economies of scale. I was hoping we saw economies of scale in the answers. I think Jasmine did talk about financial economies of scale, question mark. Absolutely. Bigger banks can borrow more cheaply from other banks. Established banks have big fixed costs, payments infrastructure, but millions of customers, which reduces the cost per customer. They can raise equity and debt more cheaply. And of course, they've built up, as many people said, brand loyalty. Brand loyalty. There we go, really good question. So it's not always easy for new banks to enter the market. That's why banking is essentially an oligopoly, essentially. Here's a nice outline question. Let's move on to, this is for EdXL fans. Can you please give me one possible cause of financial instability in an economy of your choice? I'd be really interested to see what the answers are on this one. Here we go. So now we're getting into the areas of financial instability, market failure for the next 3 or 4 minutes. Now, critically here, if we were talking about financial instability, as Kirsty does there, rather than economic instability. We've got hundreds with us today in the live stream. Josh has obviously watched The Big Short. Oh, Siani, great answer. Great answer. LIBOR rigging, yeah. Toby talks about sovereign default. Really good answers there. Absolutely fantastic. So financial instability, of course, is rife. We tend to move from one financial crisis to another. What else have we got coming through there? Ezra Goff takes a developing country focus. Lack of banking institutions in developing nations, a lack of trust in banks due to corruption. So that would be terrific, Ezra, if you're doing Excel, but they often have a financial markets question on the development side of the spec. And the snack bandit brings in a point about China. Bad loans to property developers likely to be unrecoverable, the risk of widespread default and insolvencies. If you're following China, as many of you will be, China is yet to have its big financial crisis. So maybe China's next in line, next on the rank. And Esther has a lovely point. Poor regulatory power leading to banks building up high levels of debt and overconfidence. Well, Esther has that point. I just want to take you very quickly through the Minsky hypothesis. It's not on the spec, but I always teach it to my students. Hyman Minsky, who was at the SOAS, brilliant Marxist economist. The Minsky hypothesis asserts that during periods of prolonged economic stability, So when the economies are doing well, low inflation, steady growth and things, financial markets often become increasingly complacent and they take on higher levels of risk. Of course, this leads to the build-up of speculative bubbles, excess borrowing, ultimately culminating in financial crises. So the Minsky hypothesis, now look, if you put it in an answer, I mean, wow. But Minsky argues that capitalism is fundamentally unstable and actually that stability breeds instability. So the subprime mortgage problem was essentially driven by low interest rates and low yields and people are searching to take higher risks. The Big Short has to be one of the greatest films ever made. Next question coming up on our journey. Let's take a look at bank failures. So here's a bank that I had a mortgage with, had savings with, had shares in, if you're asking, but Northern Bank failed as a bank in 2007, nationalised in 2008. Virgin Money, of course, bought part of the bank. I think Virgin Money Nationwide is hoping to take over Virgin Money. But then either way, Northern Rock, iconic Northern Bank in the great northeast of England, failed in 2007. So here's my question for the team. Can you please give me two possible consequences for the economy of bank failures such as Northern Rock? Have a go. Here we go. Isaac, one of our great leaders in the group, saying, I beg you guys to stop asking about exam boards. It's great to expand your knowledge. Well, hopefully these sessions do add a little bit of knowledge and value. And some of your answers are fantastic application I'm learning from what you're producing. Yeah, Emily talking there about the link between bank failures and recession. Faye producing a similar idea. Some great answers coming through. So why might a bank failure have macroeconomic consequences? And Megan's answer really hits the nail on the head there. Well done, Megan. Yeah, lots of answers coming through. What have we got here? Harbeer has a lovely point. If we can maybe flag up Harbeer's point. Failure of a bank will lead to many losing their deposits, acting as a negative demand side shock. Now, any student using the phrase demand side shock is going to get A-star analysis from me, leading to a recession, negative growth, and potentially rising unemployment. Fantastic stuff. James Yates talks about fall in the availability of loans could lead to low investment and in turn lower long-run economic growth. Lack of options for saving money could lead to increased demand for bonds and lower yields. This is sophisticated analysis, James, and absolutely spot on. Can I share with you my 2 points? There's so many points you could make, but here, Victor brings out systemic risk, lower depositor confidence, could lead to a depreciation of the currency, hot money investors, absolutely fantastic. So a wider banking collapse can lead to capital flight, particularly, I think, for emerging developing countries. I've chosen two slightly different points. Credit crunch, of course, which is linked to what people were saying. So credit crunch is where banks basically stop lending, both to each other and to customers. Businesses and households find it difficult to obtain loans. Now, we'll see what I've done here on this little answer. In green, I've used connective words, connective phrases, to build those chains of analysis, which examiners love so much, which in turn can lead to a decline in capital investment, consequently causing weaker growth. So, super important when you're building your chains of analysis in these kind of questions to use these little connective phrases. And we have more to say about that in Grade Booster. And then the fiscal effects. So the government often bails out banks, certainly did in 2007, 2008. The national debt goes up. That might lead to higher interest rates on bonds, more expensive mortgages, and a medium-term rise in the tax burden. But some of the answers on the live stream were just utterly fantastic. So well done on that. Should we move on to the next one? Now, this is really interesting. I'm giving you a choice here. Can you outline one argument for bailing out a bank who fails, or one argument for letting banks fail? So choose which one you want to outline. Let's see what this great group of students can come up with today. Give me a line saying banks should be allowed to fail, or so the first one, argument for saying the state should bail out a bank. or conversely, an argument for letting banks fail. And Scarlett very cleverly brings in systemic risk as her answer. Yeah, well done, Sam, using a very useful concept there, moral hazard. So choose the line you want, as Kirsty's done there. Well done. Yeah, Emily says, keeping the market efficient, if not, enables the other ones to not operate effectively as they know they can be bailed out, which is hinting at moral hazard there. Gus Howland had a really terrific point. You can find Gus's chain of reasoning, quite sophisticated chain of arguments. What did Gus write? Can we find it? Failure of banks with large market power may make way for new, more efficient banks. Government shouldn't support inefficiency. Hinting there that the failure of banks creates a kind of creative destruction, which might make the market more contestable. Indeed, the rise of those digital-only banks. When was Revolut started? 2015, Monzo, 2014. We've seen the emergence of new banking models, which you'd expect to see. Utterly fantastic answers. Here's Sheila. Bailing out the banks can collect externalities to third parties, e.g. taxpayers, who had to bear the burden of the financial crisis by using a counter-cyclical buffer instead of increasing taxes. Wow. Harrison, letting banks fail takes Austrian view, leads to moral hazards and survival of zombie businesses. Harrison, you are a mind reader. Not only is that a superb answer. Let's have a look at my 2 points. So essentially, the argument for is Keynesian. People were talking about demand-side shocks. So a bailout can limit systemic risk, mitigate the negative effects of the real economy, and critically, the externalities. Banking failures have negative externalities. We all suffer the consequences in terms of living standards, higher taxes. So bailouts might help to mitigate some of the negative externalities. And Hayden says, well, what's an Austrian view? It's a view of Austrian economists. Thanks, Hayden. The Austrian school, the likes of Hayek and Schumpeter, von Mises, letting banks fail promotes market discipline and prevents moral hazard. It encourages creative destruction as new banks, innovative banking models might replace failed institutions. So the Austrian school favours free market forces, of course. Moral hazard is when if you bail out a bank, Toby, the banks take more risks. They know that the gains, the profits they keep, and the losses somebody else pays. So moral hazard, if you insure against risk, people take more risks. Okay. Faye has a lovely point. The Lloyds bailout, the government received back every penny of their investment. So providing, of course, the bailouts work and the government can then sell their stake without big losses, you can, again, this is a really good point about preventing systemic loss. The only commercial bank in the UK that didn't take a bailout was Barclays. And Barclays took some equity from the Saudis, several £1 billion worth, recapitalised the bank, created a good and a bad bank, and basically tried to minimise their debts and emerged from the banking crisis in good shape. Hannah says, what's a counter-cyclical capital buffer? We will talk about that in just a second, Hannah, as part of the next question. Shall we move on? Well done, everybody. Can you give me 2 ways in which commercial banks can be regulated to increase financial stability? Have a go at this one. And now we're nudging into the area of financial regulation and commercial banks. Don't worry about writing sentences, but G9 is bang on it as always. Well done, Sam. That's a nice answer there. Focused and very clear. You can develop it, obviously. Yeah, some good stuff here. This is a little bit dry, isn't it, financial regulation, but it's worth knowing about because it does come up. It won't be a 25 marker, but you need to have some knowledge of it. Angel has come out with a brilliant answer there. Well done, Daisy. Yeah, well done. You're obviously well up on financial regulation, enforce a higher capital ratio, and perform stress tests. The ultimate stress test, of course, is papers 1, 2, and 3. Here are my two answers. Conscious of time, everybody doing brilliantly. So yeah, things like reserve requirements. So regulators can impose minimum capital adequacy ratios. Tier 1 capital, you have to have enough capital to absorb losses. And crucially, you might impose reserve requirements. I was reading just the other day that I think in Cambodia, they've introduced an 8% cash to deposits ratio. In other words, the commercial banks in Cambodia can't lend out multiple amounts of money. They're trying to tighten credit supply. And the other one is I'll come on to random bananas point, which is unbelievable in a second, but stress testing. So this is where the Bank of England bought stress testing. They basically try and paint a scenario. Can a bank survive a real economic downturn? And if they can't, they have to recapitalise. So Random Banana, one of our great contributors, talks about firewalls between commercial and investment banks to reduce risk to consumers. Yes, correct. It's slightly counterintuitive, by the way, that to control a forest fire, you often have to chop down trees to create that firewall. There was something about, Faye talked about, lovely, again, Faye is one of our great application contributors. So Faye talked about Evident and Grameen Bank, a bank for the poor, for those with no collateral, lower interest rates than normal. Even though there are obviously big issues to do with the Grameen Bank. Oh, by the way, I'm doing a hot take on Bangladesh. I'm going to record that later on tonight. Here we go. So very quickly, let's just look at two things, a bit of application coming up. So HSBC is one of the world's biggest banks. This is the tier 1 capital. So this is basically what banks have in reserve to cover losses. So tier 1 capital is basically shareholder money. So HSBC has 113 billion of tier 1 capital. Might be worth adding to revision those. Barclays has 60 billion, Lloyds 37. So most of the banks now have at least 30, 40, 50 billion pounds of capital to absorb a loss if the economy goes into a downspin. And let me just quickly show you the stress test scenario from last year. They haven't performed the stress test for this year yet, but last year they performed the stress test for banks. And they asked the question, could a bank survive falling GDP of 5%, 11% inflation for 3 years, a genuine world recession, normally the world economy grows by 3%, a fall of GDP of 2.5, a doubling of unemployment, a fall of a third in residential property prices, and a fall in share prices of 45%. See what the Bank of England is doing here, saying this is if Carlsberg did downturns, this is the downturn they would choose. Can banks survive that? And every bank actually came through the stress test. So banks had enough capital to cope with a major economic shock. Okay, last topic today. Oh no, sorry, penultimate topic, again, market failure. Oh yeah, I like this question. So let's go back to last year's year 12 stuff on asymmetric information. This will be a little test for the group, a challenging question. Can you give me 2 examples, please, of asymmetric information in financial markets of your choice? Have a go. Now, ideally on this one, a little line on why. What is the asymmetric information? It could be health markets, it could be insurance, it could be banking, it could be stock markets. You choose. James, outstanding, fantastic. Yep, good. So this is one of the major causes of financial market failure. An asymmetry of information in complex financial markets. Emily, that is a great point. I'm going to write that one down, actually. These are tremendous answers. Yeah, okay, Ted, linking insurance companies. Consumers know more about the insurers and how at risk they are due to injury accidents. Absolutely right. What have we got here? The snack bandit, private equity markets, lack of standardized accounting and auditing regulations to make it difficult for acquirers to understand the fundamentals. Absolutely. So if you think about takeovers and mergers, so much information failure hidden from investors. A really good answer from Tom Sparkle. Banks not knowing the financial history of consumers defaulting on debt risk. That is a terrific, it's a fundamental asymmetry, Tom. So well done on that answer. Great stuff. And Jasmine, car insurance. I have a feeling, by the way, car insurance could come up this year, or home insurance, because there's been a surge in car insurance policies. Many of you who drive will have seen this. Young drivers will often front their insurance to get lower insurance premiums. The insurance company will find it hard to track who's driving. That is a fantastic example. And George heard, again, one of our regular contributors, information drag, hard to keep up with the most recent deals, changes in the base rate, competition, etc. There is just a complexity and a volume of information, which is even price transparency sites can't keep up. Wow, amazing. Who am I to? I've gone for insider trading. Just this morning, I think the CEO of a Dutch football club, Ajax, has had to resign, or has resigned, because he bought shares in Ajax about 11 hours before his announcement as CEO. He's lasted about a week. But basically, you're trading on confidential, privileged information. Enron, for example, and other examples. So if you have inside information, and if I was to say, for example, that GTG is going to buy Apple in a cash deal, many of you would now start buying Apple shares, probably. Adverse selection, yes, insurance markets. So people have private information, often confidential information about their own risk profiles. So they don't tell insurers about pre-existing health conditions. And wow, the answers coming through the chat window are just unbelievably good. So well done. By the way, Jim is confirming we're not about to take over Apple. But it's sometimes you've got to dream, Jim, you've got to dream big. Here's my last, let's finish off with yields. Now this is again on the spec. So I've got a lovely final question for you. Here we go. This is the yield. If you can go back, Jim, the slide. Yeah, this is going to show the chart. It's one of my favourite charts. I've actually got this posted up in the office. This is the yield on 10-year government bonds in the largest economies in the world as of 3 weeks ago. And you can see that Turkey has bond yields of nearly 28%, Nigeria 18%, Brazil, Mexico, etc. UK at 4%, just a little bit below Germany. Yes, certainly below the United States. Here's my question. This is our last question today. So well done, everybody, on a truly brilliant contribution. Can you give me 2 economic reasons why bond yields differ between countries? Have a go. Argentina isn't listed as one of the biggest economies in the world by GDP. Yeah, you've got to dream big. So why is it that Turkey has bond yields of 28% and the government borrows for 10 years, whereas Italy can borrow at less than 4%? And again, some great answers coming through. We'll pick out a few in the next 30 seconds or so. Yep, good point from Martin there. Well done. Wow. Inigo, inflation expectations. Inflation erodes the real value of fixed income investments such as bonds. So it's countries with higher inflation expectations typically offer higher interest rates. Ollie talking about the demand for the bonds, strength of the economy, and crucially the risk of loan default. So lots of you talk about the state and stability of the economy. Yeah, Alex coming in there with inflation expectations. What have we got here? People talking about exchange rates, people talking about investor confidence. Some really good stuff there. Here are my 2 answers. I'd go for the 2 big risks. When you buy a bond, there's 2 risks really. One is inflation. So typically, if you have high inflation, of course, the bond yield reflects the fact that the real value of the bond, real value of the interest might be falling. So typically high inflation countries, including Turkey, obviously in Russia and other countries, in Mexico, the risk is high. And critically, the default risk. Countries with higher national debt, external debt, typically have higher bond yields because the risk of default is higher, and critically also exchange rate volatility. So if you think the exchange rate is going to depreciate or devalue, investors will require a risk premium. Now, Faye says, what's the 10-year bond yield? Just to clarify, please. Well, the 10-year bond yield, very great question, is the yield or the interest rate when the government borrows money. It issues, for example, a 10-year bond. So the UK government is issuing bonds this year in 2024 to repay the bond in 2034. And the yield is essentially the interest rate that they have to offer investors to buy those bonds. So essentially, it's like a mortgage. It's the cost of taking out a loan for the government. And typically a 10-year bond, well, in recent times, the bond's been around 2.5%, 3%. It's now up to 4%, and obviously the rise of inflation. And although the pound's been quite stable, that's helped bring down bond yields, certainly compared to 2022, when there was a highly successful budget by a former Chancellor and Prime Minister. Utterly brilliant answers. Utterly brilliant. Hopefully you found the last 35 minutes useful. Is the grade booster good for AA star students? I hope so. That's my aim. Our grade booster is essentially a day where we just focus on application, on lots of examples of how to improve the exam technique, and then the structure of the papers you're taking. I think it's a great day. I love doing it. And it's fantastic to meet students and teachers live with big screen, digital screens to help along the way. We've had amazing contributions today. I think you're in great shape when it comes to financial economics. And hopefully you've learned one or two new things as well, things like the Minsky hypothesis. Tomorrow we are doing behavioral economics, Thursday, behavioral economics. And then Friday, we've got a big session on development economics. So those are our 3 sessions for this week. Now, next week, we're doing some more revision each day at 11:30. And again, post in the comment section of the video the topics that you'd like us to cover. This is session 5, isn't it? So next week, we'll probably do four sessions. And post in the chat window or the comment section the topics that you'd like us to cover. And we'll prep up some sessions ahead of next week. Well then, everybody, take care. If you found it useful, please press like and subscribe and spread the word to other people. Numbers this week well up on last week, so I think people are really getting into revision mode. And check out, of course, the TuTu website for downloadables, things like our knowledge organisers. Yeah, big thanks to Jim as well for being a great producer, picking up the great answers as we went through this session. So well done, everybody. Take care. Stay safe. Stay positive. Stay curious. And see you sometime soon.